Hi, and welcome. You're listening to the X22 Report. My name is David. This is episode 1248, and today's date is April 6, 2017, and the title of the episode is The Economy is Imploding at a Faster Pace, and You Need to Be Prepared. Let's get into the economic collapse financial news. Now, today we can see the market, well, it really didn't go anywhere today. It was pretty much flatlined. It finished a little up here. But we can see right now that the economy, well, it is picking up pace. There are a lot of indicators letting us know that things are rapidly falling apart. And we're seeing some manipulation again to make us believe that the economy is doing fine. And we can see right now that the initial jobless claims, well, they have dropped off once again. Suddenly, out of nowhere, boom, they fell into the bottomless pit. Now, let's think about this for a second and think about how this is all being done. Didn't we just get a whole rash of store closings? Didn't we just get a whole slew of bankruptcies? Well, aren't people losing their jobs? Now, remember how this all works. Remember, they count part-time jobs when you're taking them as a full-time job. So if you have 1, 2 in the retail industry, in the service industry with food, that is a job. Yes, you have a full-time job. Now, if you lose that job in the part-time position that you're in, and you're not making a certain dollar amount, you're not making a certain, or you're not working a certain number of hours, and it varies from state to state, you can't apply for unemployment insurance. And initial jobless claims will fall. So if you have stores closing, and because of Obamacare, they keep a lot of people part-time, guess what? They can't apply for unemployment insurance. So they're just not counted. And we could see this has been going on for a very long time. So no matter what happens out in the economy, they have a way to make it look like more and more people are being employed, because if you take part-time jobs, it looks like you're being employed. If you're losing the job, it looks like nobody's applying for unemployment insurance. And they're able to get away with all of this and make you think that everything is fine until it is not. Hey, we thought everything was fine leading up to 2008 and 2009. They were telling us everything was fine. Everyone was believing it. Everyone was purchasing more and more homes. They thought everything was great. Unemployment was what? 5% around that time, maybe even 6%. It was hovering around that nice low area, and everyone thought, okay, not a big deal. And then one day everyone woke up, and what happened? Unemployment just shot right up. Everyone's world came to a screeching halt, and everything went haywire. And we're going to see the same thing. We're seeing more indicators out in the Miami-Dade area. Condo sales right now, they have plunged. Now, I remember back in 2006, 2007, coming down to Florida, looking out into the skyline, and all I saw were cranes building buildings like crazy. And everyone's like, whoa, this is the hottest real estate market ever. And everyone was thinking, this could never end. They're building like crazy. This is fantastic. Real estate's going to keep going up and up and up. And then what happened was, well, the real estate market kind of crashed in New York, in that area. Traffic started to dry up, but down in Florida, everything was still fine. It didn't dry up there yet. It took another 6 months to hit that area. And we're starting to see it once again, because condo sales in Miami-Dade, they've plunged. The condos on the market, well, they've surged. Supply has hit a 14-month high. Developers are sitting on completed units they can't sell, and month supply in their projects has reached several years. Sales are down now by 25% from February 2014. Inventories up by 90% since 2013. And you'd expect prices to head south, but for some reason, prices are continually moving up. Seems like there's something wrong here. And what is happening is the data is flawed, because from 2009 to 2016, the data was full of sub 150,000 sales of bombed out foreclosure borderline worthless properties. And those properties have worked their way through the system and are the weak comps that make the reported year-over-year average or median gains true but entirely meaningless. So the median price is up by 6.3% year over year, but it's meaningless because the prior year data was pushed down by nearly worthless foreclosed old condos working their way through the process. These units are still not totally gone. Miami Realtors Association lists them as under 50,000 on page 8 of their report. The consequences when Realtor published data shows median prices are rising, though in reality prices of good condos are declining. So what is driving real estate agents crazy is that the local and national real estate association keep on putting rosy reports out there saying prices are up by 7% this month. But then the agent, well, they get hit with reality, and they have to explain to their client that the pricing in their condo building is actually down 20% over the last 18 months. Well, here we have the difference between creating manipulated data for the corporate media and for the country to make you think that things are fine. And then you go ahead and you try to sell or buy or anything like that. Reality then is something's wrong here. Because, first of all, we can't sell them. There's an oversupply. And pricing is actually down 20%. And you can see how this is all done. When you're in reality, just like when you go to the mall and you go to the strip mall and you see stores closing, you see the anchor stores closing, and the corporate media is trying to convince you that, well, all of this is moving to online sales. But then you look at the real information and you see, well, only a tenth of retail is purchased online. So we have a major problem. But they don't want you to think that. They leave that part out. They just throw up numbers like, oh, 3 billion of online sales. What does that really mean? I mean, because we had we had 150 billion in brick and mortar and we had 3 billion in online. It's all the way they play with numbers to convince you and omit certain facts to convince you that everything is fine. Just like these bogus reports in the condo industry in Miami. Yes, it sounds great when you read the data, but when you actually go and try to sell something and people say, why can't I get that price? There's the reality. When you go to a strip mall and you say, okay, they have room for 12 stores, but half of it is empty, and they're telling me that retail is strong. Something is wrong here. Well, maybe it's just this area. Let me call my friends in other areas. Are you seeing the same thing? Yes, we are. Reality sets in. We're already seeing out in San Francisco in the Silicon Valley, where investors used to come in and venture capitalists, they used to come in and drop a lot of money, get these businesses going. And we had a crazy boom that peaked in 2014 and 2015. Well, it's all coming to an end. Venture capitalist investment in the U.S. downshifted again. In the first quarter, according to the current report by the National Venture Capital Association and PitchBook data, it was the 6th quarter in a row of declines, and the number of deals dropped to the lowest level since the 3rd quarter of 2010. The startup funding industry is likely reverting to 2012-2013 levels of investment after peaking during the past few years. So what's happening here is these venture capitalists, well, they're holding on to their currency. They're not handing it out. New businesses aren't starting. All the office space that was built expecting a lot more businesses to come in, well, they're not coming in. And we're starting to see office space availability is suddenly piling up after years when the term shortage was the guiding theme behind all real estate decisions, and everyone went out to grab whatever was available. And they built as much as they possibly could. But companies are cutting back now and putting unused space on the market. They're not getting the funding. Now, once this happens, they're going to let people go. When they let people go, they can't afford their homes in this area. When they can't afford their homes in this area, well, the people in the Bay Area, they're already seeing signs of a significant downturn. And nearly half the millennials say they're going to have to leave the area already. So it's already starting. We're seeing it in Miami. We're seeing it in San Francisco. We're seeing it in all these different places. And if the economy was so great and so wonderful like they're trying to convince us of, how come 50% of Americans live payday to payday and 33% can't write a $500 emergency check? I mean, that is a major problem. If we have an economy that is strong, robust, and people are getting full-time jobs and they're working and they feel comfortable, you wouldn't see the numbers like this. You wouldn't see statistics like this. You wouldn't see so many people on food stamps. But what we're seeing is the opposite of what they're telling us. And people are having a very difficult time trying to get by with all of this. And it's starting to come out now. Because what's happening is the economy is breaking down faster and faster. If you noticed, when we started reporting on this back in 2015, we had a couple stores closing. The holiday season for 2015 wasn't that great. When we moved into 2016, the beginning of that year, since the holiday season in 2015 wasn't that great, we saw a huge number of store closing in 2016. And then we said, okay, if this is what's happening right now, we know 2016 is going to be even worse. And it was. And then we said, okay, if that's going to be worse in 2016, come 2017, we're going to see a whole lot more stores close. So we are showing, and we've been looking at reality, not the fake manipulated information that they've been sending out there. We've been looking at reality, and we can see the difference between when we were reporting on 2015 and the time period of that area compared to 2017, and everything that we said was going to happen came true. So we are definitely on track for this system to collapse. And we can see already the Fed is out there, and they are looking at the situation, and they're saying, yeah, we're going to be collapsing this economy. Now, of course, they didn't say it in those terms, but everything they're doing is a repeat of 2006, 2007, leading into 2008. I mean, are they going to be able to reach 5.75% in the interest rates? No, they'll never even get that high. The system will come down and rip itself apart way before that. But something very interesting. SocGen strategist Kit Jukes said something very interesting. The wider Fed debate is about the impact on risk assets of shrinking the balance sheet. If near zero rates and central bank buying of bonds have been the fundamental driver of global capital towards higher yielding assets, then reversing both parts of this can't be helpful. They're absolutely right. It will not be helpful. And this is why the Fed was out there in their minutes saying that the market is overvalued. It's in a bubble. And they're going to have to bring it down because they know they've pushed it to the max. Yes, maybe it'll go up a little bit more, but we can see already they have everything in position. They have everything prepared to bring this down. And this is what we're seeing right now. Now, history shows us when the Fed minutes, when they go into the valuation and they talk about the stocks, how they're overvalued, and they start mentioning this in their minutes. When you start to search through the Fed's minutes in the last couple of years, going back maybe to 1996 or so, according to Kensho, they found this about 6 times of overvalued stock market in the minutes going back during this period of time. And every time this was mentioned, do you know the stock market came down? That's kind of odd. That's a strange pattern. And what we're seeing right now is they are already signaling, they're already letting you know that everything is in motion. And we're starting to see the economy come down at a faster and faster pace. And as we move into this spring and summer, and we see the Fed raise the rates again, and then once again after that, you know, because you're going to see the market start to really fluctuate at that point. You're going to see the real estate market tremble. You're going to see more retail close, and you're going to see things start to really rip itself apart. Now, they'll reach a point where they'll say, okay, we raised them enough, the economy is destroyed. They know already at that point that the economy is destroyed. They will say, okay, we're going to start lowering the rates. This is what they did prior to 2008. They'll start lowering it a little bit. They know it's not going to help. The economy it's like a domino effect. They already flicked the first domino, and now it's hitting all the other dominoes. So it doesn't matter if they continually reduce the rates, but they know they have to reduce the rates because when the crash comes, they know they need to go to negative. That's why Bernanke said the next economic crisis, the Fed most likely will have to go into the negative territory. And this is where we're headed. So you need to get prepared. You need to get ready for what is about to happen. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.